of Business Administration at Harvard Business School, and I have the privilege of convening this seminar, which is the Chinese Economy Seminar run by the Fairbanks Center. So this is our first event of this academic year, and we've been trying to get Arthur Kroeber to come for a year and a half now, I think, and he's finally agreed. Maybe because I convinced him he owed me a favor. So in any case, it's really an interesting time to have a talk about, as Arthur has titled this appropriately, has the Chinese economy hit the wall? And there's no one better to give it than Arthur Kroeber. He's the founding partner and head of research at Gavekal Dragonomics. Arthur co-founded the China-focused research service Dragonomics in Beijing in 2002 and was the editor of its flagship journal, the China Economic Quarterly, through 2017. And now he's head of research for the combined operation of Dragonomics and Gavekal. Before that, he spent 15 years as a journalist specializing in East Asian economic affairs and reported from China, India, Pakistan, many other Asian countries. He also teaches economics at the NYU Stern School of Business and is a member on the Council of Foreign Relations and the National Committee on U.S.-China Relations, senior non-resident fellow at the Brookings-Tsinghua Center in Beijing. And his book, which many of you have encountered, whether you like it or not, The Chinese Economy, What Everyone Needs to Know, was published by Oxford University Press in 2016. The new edition, which was available in 2020, is widely used in many university classrooms, including likely this one. So, so we're really grateful to have Arthur here. And with that, I will turn it over to you. Thanks.
Great, thank you. Everyone likes my book. No one doesn't like the book.
Yeah.
I know what you're talking about. Okay, thank you very much. Am I audible in the back there? Yes, okay, good. So thank you very much for that kind introduction. I don't think it actually took very many invitations to get me here. I think there were just some, I was in China or something, scheduling problems. Very happy to be back here. And the timing, which I don't think we predicted when we set this up, is very fortuitous because we spent the summer reading headlines about the impending doom of the Chinese economy. And so part of my job here is to sift through some of the narratives that got put out over the summer in response to some specific events in China, and then hopefully put those in the context of what we see happening longer term. And I will hopefully be less verbose than usual so that we can have plenty of time for some back and forth on this. So I guess the starting point is, this is basically what we were reading this summer, that not only was China going through a bad economic patch, but that this was symbolic of deep underlying problems that implicate China's ability to keep growing and keep exerting influence in the world for years and decades to come. And if you want to be, a little bit flippant about this, it's like basically we had 3 months or 4 months of bad economic data, and then people came out of the woodwork trying to establish that these 3 or 4 months of data justified grand narratives and stories that they've been telling for years and decades. And kind of this was their moment to say that, yes, we have now been proven correct in all of these critiques that we've had of the underlying structures of the Chinese economy. And to be frank, I think a lot of these arguments were trying to make a very small number of data points do an awful lot of work, right? There was a lot of grand narratives being to a fairly small evidentiary basis. But I think it is fair to say that, concerns about the sustainability of Chinese growth have been rising a number of years. Concerns about the ability of China to continue balancing between an authoritarian political system and a capitalist economic system have grown a lot as the political system has become much more authoritarian and much more personalized under Xi Jinping. So while I think a lot of the hyperventilating over the last few months was frankly not all that constructive, I do think that the underlying questions that people are anxious about are real and they're very serious. And so I think the question is to figure out, like, just what's the exact nature of these problems? What's the nature of the risks that are building up in China, and how close are we to some kind of major inflection point in the trajectory of Chinese growth? So just to summarize, in any speech like this has to have its straw man. So here I have my straw man that I have put together, sort of my interpretations of other people's arguments. But broadly speaking, I think you can report three major descriptions of Chinese economic troubles this year. The first two are saying these are what we're seeing now is symptoms of these deep structural malaises, and so there's big problems. And the first one of these is what you could call the debt trap problem. There are different variants of this, but the basic idea is that for the last 15 years, China's growth has depended very heavily on investments in infrastructure and property. A lot of this was financed by debt. A lot of this debt is not repayable or is having difficulty being repaid now. And so China has built up this kind of unsustainable debt pyramid. And now the bill has come due, and China is basically stuck in a situation very similar to the situation of Japan in the early 1990s. And in fact, Richard Koo, the economist who came up with the description of the Japanese problems in the 1990s of a balance sheet recession, came out and he was asked, is China in a balance sheet recession? And he said, yes. So there is a school of thought that says basically what we're seeing here is the inevitable secular slowdown of China's growth trajectory because of the buildup of unsustainable debt. Second, even broader argument is one that was advanced most lucidly by Adam Posen in Foreign Affairs recently. And his argument is essentially the fact that consumers and entrepreneurs did not respond to the end of COVID restrictions in China by shooting the lights out and just booming back into revenge spending and revenge investment and dynamic growth. This proves that consumers and private entrepreneurs have lost confidence in the fundamental Chinese system. And so we now have the victory of Leninist political structures over the dynamic economy. And so China is now, again, stuck in a much, much lower growth trajectory because of the failure to come to a good reconciliation of its political and economic systems. Then there's another explanation, which is a little bit more, it's a little bit more contingent, I guess you could say, or it's not so much of a grand narrative, it's a little bit more empirical. And basically it just adds up all of the various reasons why this year turned out to be, very disappointing. So you had a government that really didn't put much money into consumers' pockets during the COVID lockdowns. The end of the COVID restrictions in China was very chaotic. There was a lot of confusion in the first part of this year about what government policy was going to be. There's a sense that probably there does need to be a little bit more government stimulus to get economic growth going, but the government, for whatever reason, doesn't want to do that. And this was combined with the fact that exports, which had boomed in the previous 2 years because of increased demand for electronics and all kinds of other stuff that China makes, had slowed down. So you had various kinds of miscellaneous domestic problems, some bad policy choices, and combining with, just by luck of timing, with a slowdown in exports. And so, and on top of this, you have the pressure on foreign companies to invest less in China because of US politics. And so all of these things sort of combine together to produce a disappointing outcome. And the recipe for solving this is basically the government just needs to step in and do more stimulus. And I think there are, frankly, a lot of people in China who would subscribe to some variant of this view, that this is not sort of a grand moment, secular turning point. This is just sort of a bad combination of factors, which requires more skillful macro management. than we have seen so far. I guess my conclusion on this is that all of these different explanations do have a piece of the reality of what's going on. I wouldn't sort of dismiss any of them out of hand. It's clear that China for years has been building up significant systemic debt problems. That is true. It has been clear for decades that there's a very uncomfortable balancing act between the Communist Party's demand for complete political control and their attempt to create a dynamic, innovative economy. Those things don't naturally live together too comfortably. And it's also very clearly the case that you just have a number of individual factors that happen to combine this year for a bad outcome. But I don't think it's enough, and I think we can come up with a better way to describe what's going on in China. First step towards this is to understand where the problems in these various narratives lie. So if you look at the story that, China today is basically like Japan in 1990, superficially, there's a little bit of resemblance there in the sense they were both high debt economies. They both had big property bubbles. And the resemblances break down pretty quickly after that. So this is one illustration of part of it, which is just the asset price bubble that you saw in Japan in the 1980s was many, many, many times larger than the asset price bubble that we've seen in China. So yes, there clearly are some issues with the Chinese property market that are quite serious and are going to take a while to resolve. But we are not seeing the kind of just extraordinary misvaluation of underlying assets that you saw in Japan. The other, I think, critical difference is that if you look at the total sort of the political economy of Japan then versus China today, it's quite different. And in Japan, not only did you have a big property bubble, but you had banks that owned the shares of companies that owned the shares of banks. So the balance sheets of corporate Japan and financial Japan were fundamentally intertwined, and everything was collateralized by land values, which went completely crazy in the late 1980s. And so what happened is that when that bubble popped and the asset values came down, the balance sheet of the entire country basically came down as one. And this is what Richard Koo described in his book about Japan in the 1990s. China, and I'll get back to this later, is a more fragmented system. And I think it's a little bit of an error to assume that debt in one part of the country necessarily has an impact on another part of the system that is in other ways largely unconnected from it. In fact, Chinese policymakers have been pretty careful to ensure that the kinds of cross-shareholding structures that exist in Japan were not permitted in China. So the corporate and the financial systems were different. And so I think that enables a very different kind of solution to the problem. First of all, it's a different problem, and it creates different solutions than was the case in Japan. If you look at corporate China, and I will admit, this is only the listed firms, so there's like a gigantic universe of non-listed firms out there. But if you look at listed firms, what's very striking is that they have been deleveraging their balance sheets basically for a decade, which is not as surprising if you've sort of been following Chinese policy. For the entire time that Xi Jinping has been in office since 2013, and especially since late 2016, financial risk and excessive leverage has been a big target of the regulators. And they've put a lot of pressure on companies in different sectors at different times to cut back on debt, with mixed success, but the trend is very clear. So it really is not the case that if you look at the listed universe, that Chinese corporations are burdened by unmanageable levels of debt. Now, if you get into unlisted state-owned enterprises, particularly at the local level, very different story. But the closer you get to the really dynamic, productive sectors of the economy, basically the less debt you see. So I think we have to be a little bit careful about how we talk about this. Oh, China has a lot of debt. It's not just one undifferentiated blob of debt. It's debt that exists in certain places, has certain specific, often quite large impacts, It has some clear macro spillovers, but it is not a comprehensive shroud hanging over all of economic activity. So that's the balance sheet recession story. Now, the story about, oh, people in China have lost confidence in the government. There is some real truth to this. So my last trip to China was in April. I spent a month there. And the first quarter of this year actually was pretty good. But people were beginning to get an inkling that, you know, the recovery was just not as robust as they had hoped. And I was at a couple of events where there were private sector people, and they were complaining that they just were not seeing very much consumer demand. They didn't feel that the economy was very vibrant, and so they were reluctant to invest. They were reluctant to hire new staff. There's also anyone who spends much time talking to private entrepreneurs in China will pick up that there is a lot of suspicion, hostility / hatred of the Communist Party, the government, a lot of fear that that Xi Jinping's obsession with control is just going to make their life a lot more difficult. So there's no question that anecdotally that there are certain areas where sentiment on China has become significantly gloomier. And I think most people who have visited China in the last 2 months come back with some variant of the report that people are just not feeling very positive about things. So that's true. On the other hand, if you look at the data, what you see here is not, oh, consumers have money, but they're not spending it because they're not confident. What you see here is, oh, consumers don't have as much money as they used to have. Why? Well, because there was a pandemic. There were 2 phases of lockdowns in early 2020 and then in 2022. A lot of people lost income, they lost their jobs, lost their businesses, and the communist government did nothing for you. They said, oh, you lost your job, you lost your income. Great, you're on your own. Good luck. See you at the end of the pandemic, basically. And this is very strikingly different to the United States. Capitalist United States, non-socialist United States said, oh, we're shutting everything down because the pandemic. Here, let's put a lot of money in your pocket twice, right? So those are the 2 spikes. What I'm showing here is nominal household income in aggregate relative to the previous pre-pandemic trend. That's what you see in both of these charts. Dotted lines are the pre-trends. The solid lines are the actual outcomes. And in the United States, you had not only these 2 big stimulus programs, but you can see that household incomes remained well above the previous trend long after the lockdowns had ended, because people came out into one of the tightest job markets in American history, and so were able to bid up wages. Now, a lot of this money got eaten up in inflation. In fact, real income has fell. But the reason that the US has felt dynamic over the last couple of years is because there has been this huge burst of nominal income growth that fed a lot of spending and a lot of inflation. And I think a lot of people outside of China, particularly in the US, assumed that China would do the same thing. And if it didn't, that proved that there was something deeply wrong with China. And I think you can basically argue that the only thing deeply wrong with China in this regard is that they did not support people's incomes during COVID. And so what you can see also here is that the red line consumption fell more sharply than the blue line and has failed to come up. And that does reflect a confidence issue. People see that they're losing income, that their friends are losing income. So they hunker down, they say, we're not going to spend, we're going to save because we don't know where this is going to end. So it's precautionary saving against a kind of a macroeconomic shock for which the government was not providing any particular support. Now, if you look at the most recent numbers in the right end of the chart, what you can see is the income line has been steadily rising and is now back almost to the pre-pandemic trend. And the consumption line has been rising faster, which means that the savings rate, household savings rate, has been going down. So the propensity to consume out of your income is rising. And that does not seem to me an indication that people have permanently lost confidence in the system. I think it argues exactly the opposite, that while all of the COVID uncertainties were going on, people were very, very conservative. And it has taken them a while to get out of that because the growth in incomes has been slow, but it has happened. So I have a less metaphysical view of this loss of confidence in the consumer sector. I think it is basically an artifact of income effects that are gradually getting stabilized. And I also think that the difference between the China picture and the US picture explains some of the extreme reaction that we've seen in the United States to what's happened in China, because the assumption was that China would be exactly like the US. It wasn't, therefore something is wrong with China. And I think what's wrong with China is simply a macroeconomic mistake, arguably, that they didn't put enough money in consumers' pockets during the pandemic. Finally, there's a story that, oh, private entrepreneurs don't want to invest. Well, we can certainly go to China. We can certainly talk to a lot of private entrepreneurs who are very gloomy and negative about things. But again, if you look at the data, total private sector fixed investment is the black line. And you can see the growth there is around 0. So that's not very good. However, a lot of private sector investment is in real estate because the majority of real estate developers are private. So the data enables us to disaggregate manufacturing from services, basically. Services includes real estate. And when you do that, you see that private sector investment in manufacturing is actually pretty robust. And in fact, growing stronger than it was in years prior to COVID. Now, I don't want to put a huge amount of weight on this because there are a lot of problems in the fixed asset investment data of a technical nature, which I don't want to go into, but it is very, very difficult to reconcile this data with the story that there's some kind of widespread malaise among private entrepreneurs. And you can certainly find many, many industries, particularly in these sort of tech-intensive sectors favored by the government, that seem to be doing fine. So again, a little bit of skepticism about the private entrepreneurs have given up on China. It's also interesting to me that the two big stories that came out of China this year, they were in simultaneously, is number one, China's economy is going off the rails, it's collapsing, the Leninist bill is coming due, Xi Jinping has a failing model, it's all bad, bad, bad. Oh, China is also suddenly the world's biggest exporter of cars in the world. Bigger than Japan, bigger than Germany, bigger than South Korea. China is invading the world with electric vehicles that are not only cheap, but are higher quality and technologically more sophisticated than those of their European competitors. And this has all happened basically within the span of the last 2 or 3 years, as you can see here. So, and you can tell similar stories about China's position in clean energy industries and stuff like that. Is this really a situation where you have an economy that is, imploding or stagnating, and there's no dynamism or entrepreneurialism left in it? I am skeptical. I think it's more complicated than that. Okay, so having explained what I think is wrong with what everyone else thinks, I will put my cards on the table and suggest a better way of thinking about this, which incorporates, I think, a lot of the valid insights from these different critiques. Because as I said, I think all of these stories are getting at some things that are really there and we need to take seriously. Okay, so I think these are the sort of concepts that we want to keep in mind. First of all, the direction from the top, the policy settings at the very top of the system are different now than they have been at most points in the last 40 years of Chinese history. So the Communist Party's #1 priority has always been to keep itself in power and to squash all alternatives. But for most of the last 40 years, the #2 priority, which ran a very close second, was to maximize economic growth. And there was always like an interest in technology and stuff like that, but the leaders tended to be fairly agnostic about where the growth came from. Any kind of growth was good as long as you could be persuaded that they could keep doing it. And I think it's pretty clear that Xi Jinping just does not share this view. He does not view economic growth as an end in itself. And this is a real difference between him and all of his predecessors. If you do a word count of his speeches at the 5-year party congresses, you can see a steadily declining share of references to economic reform and a steadily rising share of references to security and technology, right? And I think that reveals what he's thinking about. So security, which is very broadly defined, self-sufficiency in technology, very important in part because the United States has decided that it wants to deny various kinds of technology to China permanently. So if you're a Chinese leader, you have to think about, okay, if we can't get it from the US, maybe we have to make it ourselves. Technological upgrading more generally, and social equity, making sure that the benefits of growth are spread more generally. And I think the ones to focus on for this discussion are really the security and the technology ones, and particularly technology. I think if you want to think of an index of success for Xi Jinping, it would be some index of China's technological capabilities, not its GDP. Because as long as China has the technology to advance, provide a good livelihood for most of its people and project its power internationally, I think he will be satisfied. And if lower growth rate comes along with that, he's not terribly fussed by it, right? So that's one point. I think, and I'll sort of, this will presage a thing I will say at the end. I think he also is, the evidence is that she has a kind of a puritanical sort of view of things. One might almost call it Germanic in its economic manifestations. And, you know, I tend to think that he thinks that austerity is good for people. And this is, I think, clearly filtered down into the way the macroeconomy is being managed. And I'll come back at the end to elaborate on that a little bit more. Okay, so that's point one. Top level direction is no longer go for economic growth. It's go for security and go for technological upgrading. Second, it is very clear that there is a top-down process of capital reallocation going on here, because Chinese economic leaders have recognized, I think for several years, that the economy was too reliant on infrastructure, too reliant on property. These drivers had exhausted themselves and they needed something new. And if you read Chinese sort of economic strategy documents, basically what they say is, we need to have a technologically advanced society. And so technological development and upgrading is going to drive productivity and economic growth. That is where the capital needs to go. It needs to stop going to property and infrastructure, and it needs to start going to these other sectors. And, you know, if you strip the sort of top-down political rhetoric out of this, I think most ordinary economists would say, yeah, that's a good idea, actually, because these are sort of high productivity industries. These other things, the old drivers, are exhausted. So yes, we should see a capital reallocation from one to the other. Now, I think where people have problems is a lot of economists would like to see that being done by the market. And here it's the state saying, we're going to move it from here to there. But I think it's important to recognize that, okay, yeah, this is a politically driven decision, but it's also an economically fairly rational decision. I think it has some clear limitations. If you try to run an entire economy totally on the basis of industrial policy, I think you're limiting your options, but it's not crazy. And then third, and I've alluded to this before, is that you have this debt problem, which I view as not as a threat of collapse, or even as necessarily something that dooms China to a particular growth rate, but as a constraint on policy. So you do have very, very high levels of debt. A lot of this is concentrated in entities affiliated to local governments, state enterprises, and so forth. There's a complex of entities that are affected by this. And working out all of these debt program problems is going to be the work of several years. So they're going to be dealing with this throughout the 2020s. But as I said before, I think the debt problem is fragmented, and it is not necessarily the case that the large debt problems in the infrastructure and property complex will retard the ability of the more productive parts of the economy to keep moving ahead. Not necessarily. Could happen. Okay. So if you accept these premises that these are kind of the three factors lurking in the background. What does this mean for the economy, the stuff that we really care about? So I put two negatives and one positives here. So the negative is, I think this is what we're seeing now, and I think this is likely to be a theme of the next several years, is I don't think China's economy is collapsing. I don't think they've hit some inflection point where they're, going into some kind of huge stagnation. But I do think that they have set themselves up for a chronic shortfall of aggregate demand. Because in the most simple sense, you have an enormous amount of demand that was created in the economy by all this investment in property and infrastructure. And now you're saying we have to cut that by some gigantic amount. Right now, it's about 40%. And we're going to substitute for that by investing a lot more in semiconductors and robots and AI and green energy and so forth. And if you do the arithmetic on it, it is very clear that the loss from the property infrastructure complex is much larger than the gain that you can reasonably expect to get from those industries. So you just have created a hole in aggregate demand on the investment side that you can't really fill in the way that you've said that you're going to fill it. Well, now there are other ways that you could fill it. You could say, okay, well, we can keep leveraging up, and they've said no, can't do that. We have to keep a tight line on debt, and we have to force people to deleverage. And in fact, that's why we have a property problem in China today. It's because the government 3 years ago said there's too much debt in property, it's overextended. We have to force a deleveraging, even if it's very painful. So this is why I say it's a constraint on policy, is that it is very, very difficult when you have a cyclical downturn for the government to step in and say, oh, let's just loosen monetary policy for a little while and pump a bunch of money into the economy and get things going, and then we'll draw back later. They're very reluctant to do that. Third, you could say, well, okay, what about the consumer? People have been talking about rebalancing towards consumption for years. Why don't you set things up so that the consumer can be more of a driver of economic activity in China? And the answer is that basically the economic elite policymakers in China do not believe on that in principle. I don't think they have ever believed that rebalancing and making China more like a US-style consumer demand-driven economy is the correct thing to do. I think their model of how economies work is there is investment. If the investments are in the right high productivity things, this will create, all of this industrial capacity. This will create a lot of good jobs, high-paying jobs, service jobs downstream from that. And so you'll get consumption as a byproduct of correct investment decisions. And this is fundamentally a sort of mercantilist way of thinking about it, that economy is about production, it's not about consumption. And it leads ultimately to an investment-heavy growth model, persistent trade surpluses, because you are always producing more than you're consuming. The consumption is a lag to production, and so you've always got a surplus of investment over consumption, which gives you a trade surplus. And I think this is just deeply embedded. This isn't just something that Xi Jinping or his colleagues came up with. I think this is deeply embedded for a long time in Chinese policy. And if they had any doubts about that, they were ended in 2008 with the global financial crisis, which I think they took the lesson from that the American model was not something that they wanted to pursue. And what they're more interested in doing is looking like Germany. I'll come back to that. So I think if you want to come up with analogs to the sort of specific economic problems that we're seeing today in China, I think Japan in the 1990s is maybe not the best. There's no perfect analog. One is actually United States 10 years ago, and for most of the 2010s. You remember secular stagnation? This is a big thing. The US, it was just like dead, right? Because all of these forces had combined to make it impossible for productivity growth to come back. You had all kinds of people like Robert Gordon arguing that you'd had this productivity boom years ago, which is not replicated in the internet age, and so forth. And I think you can make a very strong case retrospectively that the problem in the 2010s in the United States was not secular stagnation. It was the fact that we didn't do enough to stimulate the economy after the financial shock of 2008, 2009, that we should have done a double or triple fiscal stimulus. We just had a problem of shortfall of aggregate demand because essentially an austerity mindset had taken over and captured the political system and made it impossible for anyone to seriously argue about just pumping a lot of money into the economy and seeing what happened. So I think there are very strong echoes of the kind of US policy, economic policy discourse of a decade ago in China today. You could also look at Germany in the 1990s after it reunified, very major shock, a government that was really resistant to any kind of stimulating reforms, a lot of efforts to restructure the labor arrangements and so forth, and to focus on essentially the efficiency of investment at the expense of everything else. So not perfect analogs, but I think you can draw at least as convincing parallels between those episodes at China today as with Japan. Okay, so that's, I think, a feature of China that we're going to be living with for a while. Second, and this is deeper, Yasheng Huang down at MIT wrote a book 15 years ago called Capitalism with Chinese Characteristics. And in this, he came up with a really useful concept called directional liberalism. And the problem he was trying to solve was, why was it that entrepreneurs in China in the 1980s and 1990s who had no real property rights, no assurance that their investments wouldn't be confiscated by the state, how come they were so willing to invest and be entrepreneurial despite these problems? And basically his answer was, they saw that Deng Xiaoping and various other people at the top of the system were saying, this is the broad direction for China. Over the long haul, we're going to get more open, we're going to get more dynamic, there's going to be more markets, and yes, there'll be cycles along the way, but the direction is clear. And they bet on that direction. And I think that's a very powerful and useful insight for understanding the way that China developed, from the early 80s into the 2000s. And so I basically believe that. I think the problem is, if you believe that, you now have to agree that we are no longer in an era of directional liberalism. We are in an era of directional something else, not liberalism, a direction towards more centralized one party and one person rule, more control over every aspect of society, something that is decidedly not liberal. And I think this sense of that there's just been a clear sense of overall direction in China. It's complicated, but I think it's basically true. I think this explains why lots of people who made their money in the earlier era are now feeling very dispirited. And I think it also explains a lot of the commentary outside China that says, well, you've changed this direction and this new direction cannot possibly work. I think if you look at the available evidence, it's not clear to me that this change in direction has yet really permanently damaged the dynamism and innovation of the Chinese economy, but you can easily imagine how it could, right? So that is, I think, to me, a more useful way, maybe of framing the Posen argument that we really have moved into a new era. But that's not something that happened this month or this year. That's something that's been growing over Xi's tenure. And it could change if Xi has a heart attack. Okay, third consequence is, I think it's clear from all of this that we are likely to get slower growth. But slower growth can coexist with a lot of technological success. So China's economy has a terrible year, yet they become the world's biggest exporter of vehicles and world leader in electric vehicles. I think we have to be respectful of the fact that the manufacturing ecosystem that has grown up in China over the last 30 years is extremely powerful. There's a lot of embedded knowledge. There are a lot of networks, supplier networks. they cannot just, they're not going to go up in smoke, and they can't be moved anywhere else or replicated anywhere else with very much ease. Once you have a big industrial manufacturing base like this, it is very difficult to dismantle. It has a lot of momentum. And I think you can point to a lot of individual sectors where there's also significant innovation within these manufacturing industries currently. And I think this is important because when we talk about the problem of, security and a sort of a more Orwellian security state, surveillance, and this loss of direction liberalism, that is really, really bad if you are Jack Ma running an e-commerce and fintech company. It is really, really bad if you are Pony Ma and you're running a social media platform. It is very, very bad for people in sort of these highly visible internet service platform industries, which basically rely on social mobilization and the accumulation of huge amounts of personal data. Why? Because they are a potential political threat to the regime. These types of concerns do not apply, I think, so much if you are making electric vehicles or batteries or looking at the next cancer drug or all kinds of things. And I think there's been a lot of work to suggest that in these sort of less visible, more sometimes described as hardware sectors, the sort of concerns about the bad direction of China politically and socially are much less, and it's much less of a detriment to their innovative capacity. I think over the very long run, it's kind of hard to see a really innovative economy thriving in a political system that is becoming as dark and as controlled as China seems to be becoming. But I think that could be a very long transition before all of the elements of dynamism are wrung out of the system. Okay, so a few concluding remarks to try and add it all up. So where do I think China is headed? So first of all, I think a lot of the China slowdown rhetoric is kind of like, yeah, of course, China's getting richer. As countries get richer, they slow down. So here we've plotted China's growth rate, per capita GDP growth rate, against its level of income. So as you go from left to right on the chart, you get richer. And we've plotted it against the other big East Asian economies with whom China shares many features. And what is noticeable is that China is pretty much doing the same thing that Taiwan, Japan, Korea, Singapore did in their heyday. It is not an outlier. It does not seem to be moving out of this pattern in any dramatic way. This is a smoothed figure. If you look, I do have a chart that shows the unsmoothed figure. So for 2020, China is down here at 2%. Then the next year was up at 8%. And this year it's probably going to be somewhere in the middle. So it's very volatile because of COVID. But if you look at the trend, it's not clear that they're falling off the cliff. So I think part of what's going on is that China is just naturally hitting a period of significantly slower growth. I think it's unreasonable to expect them to keep growing as fast as Korea and Taiwan did at a similar stage, because Korea and Taiwan are much smaller. Their export economies could be a huge part of the total economic picture. They could rely a lot on external demand. China's just too big for that. Can't do that. The other interesting thing is if you look at Japan, which is the low man on the totem pole in this chart, you can see, yeah, that after reaching China's current level of income, Japan only grew by like 3.5% for the next decade. That decade was not the 1990s, it was the 1980s, when most people thought Japan was this ultra dynamic economy that was going to take over the world tomorrow, right? So the point here is simply to say that we need to be a little bit careful about saying, okay, China is now going to grow at some more normal rate than we're used to, a lot lower. It may not even grow fast enough to ever catch up with the United States. That doesn't necessarily mean that it is an economy without dynamism and without a lot going on. And I think that's failing to sort of put those two things together is is a flaw in some of the negativity that we see now. If you look at China's technological gains, very difficult to measure because there's no single index. But one thing I look at is just China's share of global manufactured exports. And the hypothesis here is very simple. If you're going to be competitive in exporting manufactured goods to the rest of the world, you cannot do this on a long-term basis purely by being the cheapest game in town. That leads nowhere. If you are going to be really successful, you have to keep upgrading your technology. So an increase or a maintenance of a high level of global manufactured goods export share, to me, is prima facie evidence of strong technological foundations. And if you look at the red line here, that is China's share of global manufactured exports. It's obviously gone up quite a lot. It's now sitting around 20%. There's some uncertainty about what the exact trend is right now. There are different ways that you can measure. But broadly speaking, China is a very, very competitive across a very wide spectrum of goods in global export markets. And this competitive does not come from a cheap currency or just cost advantages, because China's labor actually is not all that cheap by global standards anymore. It clearly comes from technological advantages as well. And if you look at the absolute numbers, the blue bars, you can see that there was just a gigantic increase in Chinese exports the last couple of years. The other key thing is it used to be most of China's exports were produced by foreign companies operating on Chinese soil. And so you can say, well, there's kind of this enclave economy, multinationals and their suppliers like Foxconn are using China as a platform, but this really isn't reflective of indigenous technological advantages in China. It's just reflective of the fact that they have a huge labor force and pretty good infrastructure. But this is no longer true. So if you look at the foreign invested enterprise share of Chinese exports, as recently as a decade ago, it was over 50%. It is now down to 30%. I mean, 70% of this rapidly rising volume of Chinese exports is coming from domestic firms, largely private or private-ish. Meg and I can have a debate about whether there are any private companies left in China today. Entrepreneurial. So again, what this suggests is that we're not just seeing China as like a vessel for other people to do their stuff in. China is actually becoming more technologically competent. So slower growth, but significant areas of technological excellence. Where I would conclude on China is, as I've been hinting all along, I think Xi Jinping's vision for China is one of what I would call a Leninist Germany. The idea is we want to be an investment-led, technologically developed country with huge trade surplus, self-sufficient in everything, low debt rates, virtuous in that sense. And that's what we want. And I'm not so concerned. Germany doesn't have the highest GDP growth rate in the world, but it is a better economy and more socially stable than a place like the United States, which is a higher growth rate, but all of these horrible social problems that we in China do not want to emulate. So my intuition is that that's kind of what he's pushing for. You can see a lot of Chinese documents that indicate that there's a desire to keep the level of manufacturing as a share of GDP high and not deindustrialize in the same way that the United States has. So a German or a Korean type of model is what. I think most likely growth rate for China over the rest of this decade is somewhere in 3 to 3.5% range, so a lot lower than we've seen in the past, lower than we have now. And I think Xi will accept this as long as he sees the technology growing the way that he needs to. So I think you can put some positive spins on this. One is if China grows at 3% over the next 7 years and India grows by 6%, the amount of incremental demand created by China over that period will be double that in India. So the base in China is so high, slower growth, still have a lot more absolute growth. So the volume effects, I think, are really important. Another thing I think that is worth bearing in mind when we look at the China-Japan comparison is, looking back, I think you can say that one of the reasons that Japan really went off the rails as much as it did in the 1990s in terms of going from being a leader in the global economy to a pretty distant follower, was that it missed the single biggest shift in the global economy in the 1990s, which was the shift to the internet. It became sort of this island. It cut itself off from the internet as a whole, never really mastered the whole networking thing. And that had huge implications, for example, their semiconductor industry and various other things. China, arguably, it has cut itself off from the global internet, but it has a pretty gigantic internet of its own, so it's probably okay there. But the bigger issue is that China has not cut itself off from what appears to be the major shift of this coming era, which is the green energy transition. In fact, it's a leader in that era. So again, I think there's a question about, is China missing the point of what's going on in the world, or are they actually doing a pretty good job of anticipating new changes? You can argue that they're doing a good job. I think the biggest question, though, is I think this problem of increased authoritarianism, surveillance, decreased personal freedom. Most of the literature on innovation suggests that it thrives when you have maximum connections between different unrelated fields. And a lot of innovation comes from just people making unexpected connections that you cannot predict in advance. And if you have a highly controlled political system, these become much, much more difficult to achieve. So over the long run, I think there is considerable risk. This system that I've outlined here leads to a situation where, yeah, China is very good at this or that technological thing, but this is not a dynamic ecosystem. These are sort of an isolated archipelago of technological success stories set in a very, very calm, motionless, non-growing sea around them. That is a real risk. And so that's why I say that she has this vision, but there is a risk, not today, but over a period of time, that you create the stagnation in China because of the political controls. I think I will stop there. I have a couple more things to say about what this means in terms of sort of external influence by the Belt and Road. I also had a little bit of material on the interactions with the US, but I think probably I have given you enough to think about and talk about for now, and we can pick up some of those themes maybe in the discussion. So at this point, I believe, Meg, you are going to be the mocker of the microphone.
First week.
Oh.
I will call on people, but let me take my prerogative. First say, I do believe there are private firms in China, but also to ask a couple of questions, and I'll try and make them quick. So the first is, you said almost nothing until the final slide about external influence, and you meant China's influence in the rest of the world. So it's interesting, reading the basic, reading the basic statements. The Chinese officials are clearly saying it's a hard rebalancing for our economy, which is exactly what you're saying, and the external environment is bad. Yeah. So what is the effect of the external environment? Have US restrictions had any impact? And then, this may be a question to think about later, because I realize you're an economist and not a political scientist, but this is of course your fault, and I have to still ask you this, but is the thing that makes Germany stable, right, is its large social welfare net. Yes. So if China's economy has high-tech manufacturing in green energy sectors or in new, high-tech manufacturing sectors, that's not going to employ or enrich the wide swath of, in particular, the urban middle class in China, the way that the last growth model has. Yeah. So is it politically stable to see such a transition in China?
Okay, well, I actually never took an economics course, so I can't claim to be an economist. I usually present myself as a political economist, so I will
there's no course
address the second question with great enthusiasm. But on the first one, no question that there's a lot of concern in China about basically the breakdown in relations with the United States, the fact that, you had this trade war with Trump. I think there had been some hope that when Biden came in, there would be some modulation of that, and there was none, basically. And in fact, a much more disciplined and effective approach to cutting off key technologies. And I think they were extremely unhappy about that. And that's what lies behind this sort of defensive hunkering down. We have to provide for our own security and self-sufficiency because it is a hostile environment. So when they talk about the hostile environment, I think they're mainly talking about the US. And I think there's a question there, right? And so I think the next shoe to fall here, so we clearly have seen, some trade effects, some loss of access to technology. But the thing that has been very noticeable in the last few months, and I didn't include it here for various reasons, one of which is hard to know what the trend is. Foreign direct investment way down, and venture capital investment way down, right? And I don't think we know enough for sure how permanent these drops are, but it sure feels like whatever the amount of FDI and VC money was coming into China over the last 10 or 15 years, what comes in the next 10 or 15 years is going to be substantially less than that. I think that is almost certainly true. And the question is, how much does that matter? And I honestly don't know, right? I think there's a tendency in the West to say, oh, this is really important. The Chinese would never be able to succeed unless it was our wonderful, insights and capital that helped them along. And I think that's a little bit, grandiose. But it's clearly the case that FDI and VC capital had major catalytic effects. And we just don't know. Is China mature enough now that they don't really need that stuff? They can generate the capital on their own. The markets are sufficiently functional that they can substitute for that. Or is there some secret sauce that is really going to be lost? And that is, I think, a real risk. And that I think that's way more important than the controls on semiconductors, et cetera, which are in fact very narrowly targeted and are bad for the individual industries targeted, but macroeconomically are really not that important. Okay, so that would be my answer in the first one. On the second one, yeah, I guess there's a difference between, I was simply describing what I think is the theory of the Chinese leadership, not saying, and that is a correct and analytically perfect theory. I think you are absolutely right to point out there are a lot of elements of the German social contract that are not simply covered by industrial policy. I will say, if you look at the social safety net in China, it is pretty threadbare by Western standards, but it's a lot better than what they had 10 or 15 years ago. You can go to pretty much any remote countryside village. There will be some kind of healthcare facility. Everyone has some kind of a pension at this point, not very much. And I think the philosophy there has been that they want to create wide coverage for social welfare, make sure everyone has something, but keep the level very low because they've seen the problems that advanced countries have gotten into by overpromising on welfare and leading to unsustainable fiscal situations. So I think there's a logic to that, and it is a cogent logic, and it is a logic which I think consciously addresses the question of what do we need to do to make China stable. We think this is okay, and I think they're probably right about that. I think the deeper question is, as you pointed out, are they going to be able to generate enough high quality employment? Fortunately, the working age population is now shrinking very rapidly. So this is a slightly less urgent problem than it was before, but you still have a lot of people to deal with. And indeed, that is a potential pitfall of this strategy.
Thanks. All right, so if you have questions, raise your hand. Okay, so Dinda will come over here first. And just introduce yourself briefly.
Beyond kind of cutting.
Is that mic working?
Yeah, it's a little hard to hear. Closer.
But beyond cutting the why not shell property tax instead of just why not tax? So that's considering. Secondly, we kind of frame the transition in China, both transition. It's all there.
Just finish the question, Allison.
The hesitance behind that to be more of an institutionalized belief in Beijing that a heavy top-down, heavy investment, heavy strategy works better than.
Yeah,
doesn't.
yeah,
So
okay.
what do you
So-
see the argument?
Yeah, so the basic question is, why hasn't the government done more to stimulate the economy in various means than it has done? And I think the answer, I mean, as Meg alluded to, certainly the official answer from the government is we are going through a necessary transition. And so we shouldn't be propping up, if we stimulated, we would essentially be propping up the old sectors that need to shrink. So that is not in a long-term interest. We need to just suck it up and accept the pain and undergo this structural transformation that will lead us to a better place. That's the official view. There's certainly a lot of debate on this. In fact, you probably saw there was a headline today about Yi Gang, former head of the central bank, saying, you know what, we're not stimulating enough. We need to pump more money in the economy. So there are plenty of people in the Chinese system who believe that this is just a mistake and that you don't have to be so, excuse my language, hard-assed about austerity. You can achieve the structural transformation, but still do more to support growth. But that clearly is not what's being done now. And I think the other potential explanation is that messaging from the top has been a little bit unclear. And this is a complaint that you get a lot in China, that, and this was very much the case during COVID and in the exit from COVID, that people don't want to do things because they're not sure what the top guy wants, and they would rather do nothing than make a mistake. So I think we don't know for sure how much of the current policy mix is a completely deliberate, carefully thought out strategy, and how much is just like an artifact of bureaucrats making sort of opportunistic decisions and not moving because they think it might get them into trouble, and the top guy not giving a sort of a clear sense of what he wants, right? I think both of those interpretations are out there. But I tend to believe that there's like, and again, I remember 10 years ago, we just like had a political consensus in 2010, 2012 that, oh, you couldn't stimulate, it would be terrible, moral hazard, all kinds of horrible inflationary, terrible things would happen if you pump more money into the economy. And the price that we paid in the United States for that was 10 years of below potential growth and kind of a political revolution when people got unhappy with that. So it's not just in China that you can sort of get people committed to a sort of a moral, virtuous path of economic pain as the route to gain. So I think there's probably some analogs there, just in terms of the political debate within China, some analogs of that to what we went through here 10 years ago.
All right, maybe we'll do two at a time this time,
Yes.
just to see. Do you have your question up? Oh, well, you have the mic.
I got the mic.
Yeah.
Okay, so my question is kind of a follow-up to what you're talking about now, which is, it's really about the sort of psychological and political aspects of what we're seeing unfold. And, you know, for the past many decades, we've all thought of there being a kind of a social contract, which was, you know, tremendous economic growth, and your incomes will increase dramatically, all that kind of stuff. Don't play politics, you know, we'll have control over that side of things. And that was pretty much okay to people. So the question is, if you don't have that kind of economic growth going forward, but you have increasing, you know, tightening in the political area, is that, you know, sustainable? What will happen?
Yep, good. So do you want to take the second one?
Yeah.
Thanks, Linda. And then the second question here.
So it seems it's isolating the process, and also the no longer developing the real estate suggests that we will be having, if not loss, but at least no continuing in growth in the welfare of the most family, which is predominantly real estate. And if majority of the people no longer have the benefits of economic growth, but it looks like your presentation shows to be clear, which is going to be the owners of manufacturing the capitalists that will enjoy most of the benefits.
Right. Yes. Right.
So in that sense, why do you still promote in China the policy to be relaxed or financial markets to be continuing to grow? Is that a possible way to shield or harbor this wealth that people want to grow? Or
So wait, are you asserting that there is a policy for growth of the financial markets, and you're asking why that policy exists? Or
yes, that's not fire.
right.
That's growth in the financial markets.
Yeah.
Will be the next phase.
Yeah.
When the real estate market or the other.
Yeah.
That's traditionally people. That's their funding wealth of.
Yeah. Okay. Good. All right. So on the social contract, yeah, but you can create new social contracts, I think. And I think that's what these various invocations of the China dream and so forth are about, is to try and steer people towards a more traditional understanding of, the virtuous life and the correct relationship between the rulers and the ruled, right? So I think there is a fairly extensive propaganda effort going on to shift away from that old social contract, precisely so you don't get nailed when people say, well, why is my income not growing at 10 or 15% a year? And I think, the anti-corruption campaign fits into this. My observation is that this is very popular with most people. There was a sense that, everyone's votes were rising, but some people's votes were rising a lot faster than everyone else's. And it's good that some of those people got in jail. So I think there are a lot of legitimacy strategies that the government can apply even in the context of lower growth, if they make sure that enough of various kinds of benefits are spread around sufficiently equally, and that you have some growth so that people do have a sense that there is forward motion, even if it's less than the past. On the second question, that's an interesting one, because there was a lot of work done 15, 20 years ago to show that as China industrialized, basically the income share of capital rose and the income share of labor fell. So if you have an industrial policy driven growth model, that could imply that you are sort of setting up a situation where maintaining sort of the income of laborers is going to be a problem. I think the way the government would see this, first of all, is that the real monopoly problems were in the internet sector, which are, in fact, the network effect's very powerful. You do have monopoly power. And so if you had an economy focused around these internet platform companies, a few people would get really, really rich and everyone else would be like a delivery guy. And I think their view is that by cracking down on that and trying to redirect things towards, more hard technologies, if you will, that actually is intrinsically more equitable. It's a good question. I think financially, it's just like they understand that there's they don't have a financial system that really fully satisfies all the needs of a modern economy, so they need to keep developing it. That's why they keep giving licenses to foreign asset managers to come in and so forth. I think that is an area where they feel like there's just a set of technologies that needs to be improved. But I think that's kind of a distinct effort from, it's in a separate bucket conceptually from the whole industrial policy sort of tendency of policy.
So Phil is behind you.
Bill Shell, I'm a retired professor of economics, but I specialize in health economics, but I'm not a threat to you. My point is this. before all this recent change, economists talk about China going to have perfect time to move to the next phase of growth with the middle income trap.
Yep.
And with the financial market needs major reform in China. And have to change the saving habits and investment of the people. Meanwhile, you're giving a projection, even on the low end, it's 3 to 3.5% growth. Can you explain how do you derive that number as a trend in light of the problem we already know China faced? To move from one stage of economic and to another stage.
Okay.
We'll take one more if there's another hand up down here in the front. I
Yes.
see. Thank you. I'm just working for it over here.
So my name is Alex. I was born in China, but this is
Can you hold the microphone?
and right now I'm doing a PhD in education here. And so just 3 hours ago, People's Daily published an article essentially saying we need a stronger state-owned enterprise sector. And I think they shifted the value proposition a little bit. Like now they could invest in longer term industry than other companies, private companies do market. So it's slower, it's longer, and it's high technology.
Yep.
Do you think that's going to work out long term in terms of both within the economy and bringing the private company into those industries?
Okay. All right. So the first question, I think you probably exaggerate the depth of our econometric precision at Gavekal Dragonomics. So the number that I'm throwing out there is a very kind of impressionistic, this is where I think they could potentially go. And it's not based on a sort of a systematic growth accounting exercise. But it's based on, first of all, the precedents that if you look at Japan, Korea, Taiwan, which shared a lot of features with China's economy, this is what they were able to do. So that, to me, kind of sets the bounds of what could be plausible. It's not a guarantee that you will do it. So that's point one. Point two, I think I've spent like over 30 years of my life looking at this, and one of the constant features is that outside observers, I think, have quite consistently underestimated the resilience, dynamism, and adaptability of the Chinese economy, and in fact, the governance system, right? And so long before people were talking about the middle income trap, they were talking about, various other terrible things that would happen in China, from financial collapse to, there's in the early 2000s, there was a theme of Latin Americanization of China because of rising inequality and so forth. And every time that one of these challenges has risen, things have emerged to deal with it. So I've grown to have a lot of respect for the adaptability of the system. And I guess the other sort of key component of my analysis here is that when I look at the micro level, at what they have been able to achieve in a wide swath of manufacturing sectors, it's extremely impressive, right? And the entrepreneurial ecosystem that exists there is very, very robust. So it really boils down to a question of, are the policymakers smart enough to give that thing enough space to grow? If so, then there is literally no problem, right? The problem in China, as I'm sure you know, is that there's always a tendency at the center to try and control things more than necessary. And given that Xi Jinping is a control freak and he's now in office for life, and we know that for dictators, the quality of decision-making just degrades over time, yeah, there is no doubt a risk that that the life of the economy could be squeezed out gradually over time. The reason that I am not sort of jumping to that conclusion as the base case now is that Xi Jinping has a lot of goals relating to the wealth and power of the Chinese state. He wants China to be a great power. He wants it to be internationally influential. And he's not going to be able to get those things unless there is some degree of vitality in the economy. So I think at some level, he is still, to some degree, a economic rationalist who is not going to tip over into a situation where the political system just makes economic growth impossible. But you're kind of making a bet on one guy's psychology there, and it does not make me feel very comfortable. And on the question of SOEs, well, I haven't seen that particular report. This has obviously been a theme for a long time, that there's a lot of interest in increasing the role of the state-owned enterprises. One of my colleagues did an analysis recently, a couple of years ago, actually looked at the state-owned enterprise share of Chinese economy over a very long period of time, basically from 1995 to 2018 or so, and it was basically static at around 30%. Did not go up, it did not go down, the composition changed. And the conclusion that we came to from that exercise was that there's a revealed preference in the Chinese Communist Party to have a significant state role in the economy, but it does not have to be an absolute majority share of the economy. And I think as long as that is the case, you can have the state-owned enterprises coexisting with the entrepreneurial sector, and it kind of works fine. I think the question is whether these kinds of policy directives ultimately lead to more and more predatory behavior, where more and more private enterprises get one way or another sucked into the state system or become vassals of state-owned enterprises. I think we've seen some elements of that happening. I'm not particularly concerned about an individual policy announcement, because those come all the time, and there are always people who have to say, yes, we are in favor of the state-owned enterprise sector. What I'm more interested in is what the actual organizational dynamics are. And it's still, at the moment, it still seems like there's a pretty significant space for the entrepreneurial side of the economy to do its thing. But again, subject to all of the risks of what happens if you have an over-controlling central presence in power for too long.
I think we're going to have to end it there, since
Okay.
we solved it all. All of the questions are answered, all of the challenges are addressed. But thank you for your questions, and thank you in particular to Arthur for making the trip and for educating